Welcome to Finance Deep Dive. Today, we're pulling back the curtain on private credit, one of the fastest growing and, honestly, one of the most mysterious forces in the entire financial world. You see, there's a new power player rising up on Wall Street, and it's operating outside of the usual banking rules. It's a market that's already commanding trillions of dollars, and it's completely reshaping how companies get their funding.
But, and this is a big but, this whole new world of finance isn't exactly risk-free.
In this video, we're going to see how it's filled with hidden systemic risks that could, well, end up impacting all of us. Okay, so let's get right into it with the boom. How in the world did private credit get so huge so fast? So, what are we even talking about here? Private credit. What is it? Well, to put it simply, it's direct lending. You have these specialized investment funds providing loans straight to companies, completely cutting out the traditional banks. And the thing you really need to get here is the incredible speed of its expansion. I mean, this is not some slow, gradual change. It's an absolute explosion in the financial world. And look, this isn't just some made-up hype. You've got major institutions like Morgan Stanley forecasting absolutely massive growth. The numbers they're throwing around are just mind-blowing. Morgan Stanley sees it becoming a $5 trillion market. Yeah, that's trillion with a T. Just let that number sink in for a second. And we're not talking about some far-off predictions either. They're projecting this will happen by 2029, building on the incredible growth that's already happening right now. And, it's not just these niche funds anymore. The big banks, they've seen the writing on the wall, and they want in on the action. I mean, just take a giant like HSBC, for example. They are committing $4 billion to private credit funds, just trying to keep up with all this investor demand. So that brings up the big question. Why? Why is all this money pouring in? What's the engine that's really driving this boom? Let's pop the hood and take a look. It really all starts with a pretty simple comparison. On one side, you have the traditional banks. After all the recent market wobbles, they're getting super cautious and tightening up their lending. But on the other side, private credit is offering something completely different. So who steps in to fill that gap? You guessed it, private credit. These funds are jumping right in, offering borrowers way more flexible and customized loan terms that they just can't get from a bank anymore. And for investors, well, the appeal is just blindingly obvious. In the high interest rate world we're living in, private credit has the potential to offer way higher yields or returns compared to your standard public debt. So what you have is this perfect storm, creating a ton of demand. Higher rates make the returns look amazing, cautious banks are leaving a huge hole in the market, and investors are absolutely starving for those better yields.
Okay, this all sounds fantastic, doesn't it? But there's always a but. There's a whole other side to the story, the hidden dangers that are lurking just out of sight.
First and foremost, a huge question hangs over this market. Is it just too murky? The technical term is opaque, but it just means it's not transparent, making it really hard to see what's actually going on inside these deals. And think about it. With higher rates putting so much pressure on companies, what happens when they just can't pay their loans back? The risk of default is definitely on the rise. Which, of course, leads to the multi-trillion-dollar question. Could a fire in this private market spread and burn down the entire financial system? And this really gets to the heart of the problem. Because these are private deals, there's very little transparency. That means there's less liquidity, you can't just sell them easily. All of that makes them a nightmare to value correctly and almost impossible to get out of if there's a crisis and you need your cash. And believe me, that credit stress isn't just some theory. It's a very real and growing concern as economic pressures keep building. And you don't just have to take my word for it. This quote from the International Monetary Fund, the IMF, spells out the biggest fear perfectly. They have explicitly warned that banks getting involved here could be the very thing that transmits stress across the entire system. They actually use the term financial contagion. So, no surprise here, all of this has put regulators on high alert. They are watching the space like a hawk, focusing on things like disclosure, how much debt is being used, and, just basic investor protection. Okay, so where does all this go? Let's look to the future and see what this new financial landscape might actually look like with private credit as a permanent part of it. Well, for one, that old clear line between public markets, stocks and bonds, and these private markets, it's getting really blurry. And because of that, we're seeing these new hybrid financial products pop up,
ones that mix features from both worlds. They're starting to overlap with things we already know, like syndicated loans.
And all this cash? It isn't just going to the usual suspects. It's pouring into the key sectors that are literally building our future.
It's funding the next big wave of innovation in artificial intelligence. It's helping build out massive infrastructure projects all over the world. And it's investing in tangible things you can actually touch, real assets.
So what about the old school banks and all this? Well, what's fascinating is that instead of just pure competition, we're seeing this new kind of collaboration, this new partnership start to form.
Yeah, banks are now actually distributing private credit products to their own clients. They're even using these funds to get non-strategic loans off their own books. It's a whole new kind of financial ecosystem.
So when you boil it all down, the takeaway is pretty clear. Private credit is a powerful, double-edged sword. As we've seen, it offers the amazing rewards of higher yields and more flexibility, but it comes with huge risks, namely that lack of transparency and the very real threat it could pose to the whole system.
Which leaves us with the ultimate question, doesn't it? Is this innovation the flexible, dynamic future of finance, or is it just the seed of the next big crisis, waiting for the right conditions to sprout?
Hey, if you like the content, don't forget to subscribe. It really does motivate us to keep posting more deep dives just like this one. Thanks for watching.